Welcome to the Techno Fundamental Report for January the 8th. Charlie Munger passed away last year, Warren Buffett's partner. He says, fish where the fish are. So when you look at the fact that there are approximately 4,000 publicly traded companies out there, you've got to differentiate and fish in the right pond. So he recommends focusing on opportunity-rich areas, which are areas that we all know have good things going on. Avoid excessive competition. I always look at stocks, and the first question I ask myself is, how much competition is there in the situation? Patience and preparation, very important. In other words, the patience idea is to where you want to wait for the right setup. You want to be patient and wait for the right opportunity. Just don't jump in and pile in. Go where you have an edge. Well, the only edge that I feel that we have is the edge of lack of liquidity risk, meaning that we have an edge over the institutions where they deal in billions of dollars in their portfolios, and they have something called liquidity risk, getting in and getting out of positions. You have an edge as a small investor. You do not really have to deal with liquidity risk. So is it door number one or door number two or door number three that you want to fish in? So let's just kind of name these things. Door number one, let's just say that's growth investing, focus investing on growth stocks. Door number two, let's just say, is value investing, where you buy low, sell high. Now, growth investing is where you buy high, sell higher. And then number three, maybe a combination of the two, or even throw in some bonds like 60-40, or even an index fund strategy. So the point being is that once you have identified a strategy, whether it's strategy 1, 2, or 3, once you've identified that strategy, you've got to stick with it, because the biggest mistake investors make is that they'll invest in strategy 1, but then no strategy outperforms all the time. So you'll have strategy 3, let's say, temporarily outperforming strategy 1. The biggest mistake you could make would be to dump your number 1 strategy and jump to a number 3 strategy. So consistency and patience are critical. So let's take a look at the indexes just to kind of see where we stand. You can see here with the NASDAQ, we are continuing to somewhat move sideways here after we made that top back in November. And so we've been basically down and moving sideways. Now, what's interesting here is that the mid-cap stocks have broken out of that sideways action. So what that means to me is that the market is starting to broaden out into the other 493 stocks versus just the Magnificent Seven. So if you look at the New York Stock Exchange, you can see that that group of stocks has broken out of a basing pattern. Here we have the small caps trying to break to a new high, breaking out of this basing pattern. But again, we're just seeing evidence here that, the market is starting to broaden out, which can be a very big positive. S&P 500 kind of broke out above that basing area, pulled back in today, but the S&P and the NASDAQ are not looking as good as the mid caps and the small caps. However, the primary trend continues to be up. We're above the 200-day moving average. The S&P has been hitting new highs. NASDAQ is kind of lagging behind the S&P a little bit, but the primary trend is up. But you can basically see the sideways action since November. Now, on the aggression index, I've got it graphed here a little differently. I've got the 25-day and the 50-day moving average on this ratio. Now, the ratio is where we're taking the NASDAQ, which is aggressive growth stocks, and we're dividing it by defensive consumer staples, Coca-Cola, Procter & Gamble, those kinds of stocks. So when this line is going up, it tells you that the growth stocks are outperforming the consumer staples, which is a very positive sign. But you can see here, since November, just like the indexes, it's been pretty much moving sideways. However, here in the last couple of days, we've broken out. Now, this line here, Jesse Livermore always talked about the line of least resistance. So you can see here, this is resistance, resistance, and now it is broken out above resistance. Now the question is, will this become support? We'll have to see. Now, we're following the IBD 50 fund, which is 50 growth stocks. You can see here again, just like everything else, we got our peak in October and November. We come down, we make a low. Now we're making, sideways action, but we have broken out above that line of least resistance. So hopefully this was the final low in this recent correction. Now, interest rates continue to be steady. This is very positive. We always tell people we primarily focus on two things. One is corporate earnings and interest rates. Corporate earnings are fine. Interest rates are stable. This is a positive. So the power index continues to stay on a buy signal. Now, whether or not the Fed continues to cut, in my mind, is somewhat irrelevant. This is a free market yield. This is what the free market says, with loan demand where it is. Right now, a 3.694 5-year Treasury is where the market wants you to be. So you can see here things are somewhat steady. Now, the volatility index, the VIX, really has come down into a very positive area. Anytime you get below, let's say, around 17, and you can see where the VIX has kind of stabilized here in the past and it's broken to a new low. This is very positive. It means that this is a risk indicator and it's telling you the risk picture is improving. Price of oil, we've been hearing all about Venezuela and all the oil and so forth. One thing I have heard about Venezuela is most of the oil can't be refined here because it's heavy crude. But anyway, long story short is the price of oil continues to decline and it continues to be in a downtrend. So right now, the West Texas Intermediate crude is at 57.13. We think the break below 60 was somewhat meaningful. Now, on new lows, you can see here the new lows have gotten under control. We're below 40 a day. This again is a positive. So we're hoping that this correction that started back in October, November has finally run its course. You can also see here with the semiconductor stocks, which is a pretty growthy area. You've got a top, you've got then this double top, and now we're breaking out above that line of least resistance. So all in all, things are looking a little bit more positive here. We are seeing somewhat of a shift, though, in leadership, less tech and more industrials and healthcare, and aerospace is another strong area. So if you have any questions, please let me know. Thank you very much.